At moments of apparent calm, the most consequential shifts often begin unnoticed. America today appears stable on the surface. Markets open each morning, paychecks clear, shelves remain stocked. Yet beneath that routine lies a quiet turning point, where debt is no longer just a policy choice but a defining constraint. U.S. federal debt now moves in the tens of trillions, while interest rates, once near zero, hover at levels not seen in decades. The cost of servicing that debt rises invisibly, month by month, embedded in treasury auctions and bond yields few citizens ever read. Investors still buy U.S. debt, but not without questions. Yields climb even when growth weakens. Credit default swaps on U.S. government obligations exist where once they were unthinkable. The dollar remains dominant, yet more volatile, reflecting unease rather than confidence. History shows that nations rarely collapse from debt overnight. Instead, they drift into moments where options narrow and trade-offs harden. This documentary examines that drift, how America arrived at a fiscal crossroads, why markets are paying attention, and what it means when debt quietly begins to shape destiny. Long before debt becomes a crisis, it leaves subtle fingerprints across the financial system. In the United States, these early warnings appear not in headlines, but in indicators most Americans never track. The yield on the 10-year Treasury rises even during periods of slowing growth, suggesting investors are demanding compensation not for opportunity, but for uncertainty. Short-term Treasury bills fluctuate sharply as debt ceiling deadlines approach, revealing political risk priced directly into borrowing costs. The U.S. dollar index, once a symbol of steady dominance, shows increasing volatility, reflecting global hesitation rather than flight. Liquidity in bond markets thins during stress events, with bid-ask spreads widening beneath seemingly calm conditions. Even mortgage rates, tied closely to long-term yields, remain elevated despite cooling inflation, quietly reshaping household decisions. These signals mirror patterns seen before past disruptions. Prior to 2008, interbank funding markets tightened without public alarm. Before the Great Depression, leverage expanded unnoticed until confidence snapped. None of today's indicators suggest imminent collapse. But together, they form a message markets have sent before. Debt is no longer neutral. It is being measured, questioned, and slowly repriced. Day by day, decision by decision. To understand how debt becomes destiny, it is necessary to trace the mechanism of economic shock. U.S. government borrowing sits at the center of the global financial system, anchored by the Treasury market, the deepest pool of capital in the world. When confidence is strong, investors accept lower yields, allowing Washington to refinance obligations cheaply and predictably. But when confidence weakens, even slightly, yields rise and volatility spreads. Higher Treasury yields push mortgage rates upward, tightening housing affordability almost immediately. Auto loans, credit cards, and corporate borrowing costs follow. Banks holding large portfolios of long-dated bonds face unrealized losses that strain balance sheets, echoing pressures seen during recent regional bank failures. As liquidity tightens, lending slows, amplifying economic drag. Meanwhile, global investors hedge dollar exposure more aggressively, raising costs across currency markets. No single event triggers this process. It unfolds through feedback loops. Higher rates slow growth, slower growth worsens fiscal math, and deteriorating fiscal outlooks push rates higher still. Debt does not explode. It compounds pressure quietly, until policy flexibility narrows and markets begin to move faster than decision-makers can respond. History provides uncomfortable comparisons for moments like this. In Argentina, decades of fiscal promises gradually eroded confidence, until investors refused to roll over government debt, forcing abrupt devaluations and inflation that wiped out savings. Greece followed a similar sequence, rising bond yields, shrinking liquidity, and sudden loss of market access once repayment was questioned. Turkey and Venezuela show more extreme outcomes, where fiscal dominance and currency collapse destroyed purchasing power and social stability. The United States is not these countries. Its economy is larger, its institutions deeper, its currency global. But the lesson is not about scale, it is about sequence. Every crisis begins with trust, then doubt, then repricing. Even advanced economies face limits. In 2022, Britain's bond market revolted against fiscal policy, forcing emergency central bank intervention to stabilize pension funds. These episodes reveal a common truth: markets tolerate imbalance longer than expected, then react faster than imagined. America's advantage lies in credibility and time. Its risk lies in assuming those advantages are permanent, Rather than conditional on disciplined choices when fiscal pressure reaches the real economy, its effects are rarely abstract. They arrive quietly embedded in everyday life. Rising Treasury yields translate directly into higher mortgage rates, keeping monthly payments elevated even as home prices soften. For first-time buyers, ownership drifts further out of reach. Credit card interest climbs, turning short-term spending into long-term debt burdens. Small businesses face tighter lending standards as banks preserve liquidity, delaying expansion or hiring. Pension funds and insurance companies, heavy holders of government bonds, must rebalance portfolios, influencing retirement security and long-term returns. A volatile dollar reshapes prices at grocery stores and gas stations, as imports fluctuate and supply chains reprice risk. During the 2008 crisis, Americans learned that financial stress does not remain confined to Wall Street. Job losses, foreclosures, and shrinking savings followed quickly. Today's environment differs in form but not in transmission. When debt dynamics shift at the top of the system, the consequences move downward, into households, workplaces, and the everyday decisions that define economic security. Faced with mounting fiscal pressure, the U.S. government and the Federal Reserve turn to familiar tools, each carrying new trade-offs. The Fed adjusts interest rates to balance inflation control against financial stability, aware that higher rates strengthen the dollar while sharply increasing debt servicing costs across the economy. Balance sheet policy, once a technical footnote, becomes central as liquidity facilities are open to calm stressed markets and closed to restore discipline. Meanwhile, the Treasury lengthens or shortens debt maturities, auctions bonds at higher yields, and depends on sustained global demand to absorb expanding issuance. Political conflict over the debt ceiling adds uncertainty, transforming routine financing into recurring risk events priced into short-term bills and CDS spreads. History shows intervention can stabilize markets. In 2008, emergency measures prevented collapse. During the pandemic, massive liquidity restored confidence. But each rescue deepens reliance on credibility. Markets now ask not whether Washington can act, but whether it can do so consistently, without undermining the trust that makes its debt manageable in the first place. For ordinary Americans, navigating a system shaped by rising debt begins not with prediction but preparation. When interest rates remain elevated, adjustable rate mortgages and variable credit become silent vulnerabilities, capable of turning stable budgets into strained ones. Liquidity matters at the household level just as it does in markets. Cash reserves provide flexibility when credit tightens or jobs become uncertain. Diversification, often discussed in institutional terms, applies to individuals as well, across income streams, skills, and assets. History offers guidance. Families who endured the Great Depression focused on reducing leverage and preserving optionality. In countries like Argentina or Turkey, those with access to hard assets or foreign income weathered inflation shocks more effectively. This is not about fearing collapse. It is about resilience. Understanding how bond yields affect employment, how fiscal policy influences prices, and how global shocks transmit into daily life allows households to respond calmly rather than reactively. In uncertain systems, prudence is not pessimism. It is a practical form of economic self-defense. In the end, America's debt story is not only about numbers on a balance sheet, but about choices made over time. Debt becomes destiny when short-term fixes replace long-term discipline, and when confidence is treated as guaranteed rather than earned. The United States still commands extraordinary advantages: deep markets, a global currency, and institutions that have weathered past crises from the Great Depression to 2008. But history is clear that dominance is never permanent. It is renewed daily through credibility, restraint, and coherence. Markets do not demand perfection. They demand consistency. When trust holds, borrowing remains manageable and options remain open. When it erodes, costs rise quietly, flexibility shrinks, and the future narrows. This moment is not a collapse but a crossroads. The path forward depends on whether debt remains a tool or becomes a master. For Americans, the stakes are personal, shaping homes, jobs, and retirement security. And for the world, the question lingers in silence. Will America choose to govern its debt or allow it slowly and quietly to govern America? What makes this period especially difficult to read is the contradiction within the U.S. economy itself. Employment remains relatively strong, consumer spending continues, and corporate earnings have not collapsed. On the surface, these signals suggest resilience. Yet beneath that stability, pressure accumulates. Federal interest expenses rise as higher bond yields roll through trillions of dollars in refinancing. Banks adjusting to tighter liquidity become more cautious, slowing credit to households and small businesses. The yield curve, once a reliable recession signal, now reflects something deeper: uncertainty about policy direction and fiscal control. Global investors still buy U.S. assets, but their behavior has changed. Demand shifts toward shorter maturities. Hedging costs rise. Capital does not flee, it hesitates. That hesitation matters. In financial systems built on confidence, hesitation is the first sign that trust is being recalculated rather than assumed. Geopolitics now intersects with America's fiscal position in ways unseen for decades. Sanctions, once rare and targeted, have become a routine policy tool. While effective in the short term, they introduce long-term consequences for trust in dollar-based systems. Countries that watched reserves frozen or payment access restricted quietly reassess their exposure, not out of hostility but prudence. As a result, investment flows into gold, regional settlement systems, and local currency trade agreements increase. These alternatives remain fragmented and inefficient, but their significance lies in intent, not scale. Financial history shows that when infrastructure becomes politicized, users seek redundancy. For the United States, this creates a paradox. The very power that enforces global rules also motivates others to reduce dependence. The dollar remains dominant, but its role subtly shifts, from unquestioned default to preferred option among several inside the United States. These global shifts translate into pressures that feel increasingly personal. As Treasury issuance expands to fund persistent deficits, bond yields rise to attract buyers. Those higher yields pass directly into mortgage rates, auto loans, and student debt, reshaping household decisions. A 30-year fixed mortgage that once felt affordable now stretches budgets to their limits. Credit card balances grow more expensive to carry, and refinancing becomes less accessible. Small businesses dependent on bank credit face tighter lending standards as institutions protect balance sheets against duration risk and liquidity strain. Pension funds and insurers heavily invested in long-dated bonds confront volatile asset values that ripple into retirement security. This transmission mechanism is not theoretical. During the 2008 crisis, Americans learned that financial stress does not remain confined to markets. Today's environment is different, but the pathway is the same. Rising debt costs slowly filter down, altering everyday life long before a crisis is officially declared. As pressure builds, the response from Washington and the Federal Reserve becomes a balancing act with shrinking margins. The Fed's primary tools, interest rates and liquidity operations, are designed to stabilize prices and markets, not to resolve fiscal imbalances. Raising rates can contain inflation, but it also increases the government's interest expense, forcing larger deficits and more borrowing. Lowering rates eases debt service, yet risks reigniting inflation and undermining confidence in long-term discipline. Balance sheet policies add another layer. When the Fed expands liquidity, markets calm but dependency grows. When it withdraws support, volatility resurfaces. Meanwhile, political standoffs over the debt ceiling inject uncertainty directly into Treasury markets, visible in short-term bill yields and CDS pricing. History shows intervention can buy time, as in 2008 or during the pandemic. But time is not resolution. Each cycle leaves less room for error and makes credibility harder to maintain for American households. This fiscal turning point is rarely announced, yet its effects are felt quietly over time. Higher Treasury yields filter into everyday decisions. Adjustable rate mortgages reset upward, credit card balances grow harder to manage, and small businesses face tighter lending standards as banks protect capital. Liquidity, a concept often reserved for Wall Street, becomes personal when emergency savings determine resilience. History offers perspective. During the Great Depression, families survived by reducing leverage and preserving flexibility. In countries like Argentina or Turkey, those who diversified income sources and avoided excessive debt endured instability with fewer shocks. The lesson is not fear but awareness. Understanding how debt, rates, and policy choices intersect allows individuals to respond calmly rather than react too late. When debt becomes destiny at the national level, preparedness becomes dignity at the personal level.